Welcome back to another video, everyone. In this video, we are going to break down top and bottom patterns. I'm going to cover what are top and bottom patterns, types of top and bottom patterns, and then I am going to go over how to identify and trade top and bottom patterns. So let's get started. So first and foremost, what are top and bottom patterns? These are reversal chart patterns where the price point reaches a similar high or bottom multiple times and then reverses the trend. So once again, this is a reversal chart pattern where the point reaches a similar high or similar bottom multiple times and then reverses the trend. Now there are multiple types of top and bottom patterns, so we're going to jump right into that. We have a double top, triple top, we have a double bottom, and we have a triple bottom. So what is a double top pattern? So double top is a reversal pattern formed when a stock makes two highs of similar price points. The stock starts as an uptrend, right? It starts as an uptrend, it goes on an uptrend. Once it goes on an uptrend, it hits the first top, pulls back to something called a neckline. This right here is called the neckline. Okay, very, very important level, neckline. Just gonna put a neck right here, neckline. Once it hits the neckline, the stock then goes back up and gets rejected around the similar point again. Once it comes down, if the stock can break the neckline, that is now considered a double top and you are looking to short the stock here. The pattern is completed once the stock breaks the neckline. Very important to keep this in mind. The pattern is not completed until it breaks this neckline. So let's go over some examples of the double top. So if you guys look right here, we have a stock on a 5-minute chart. We have a double top on a 5-minute chart. We're looking at stock Tesla. You can see pre-market, it makes a high. It gets rejected around this point. As it gets rejected, that's the first top. Then the stock has a pullback. So until right now, we don't have any chart pattern. Stock goes up, gets rejected, has a pullback, has a retracement. This is healthy. The level it retraces to, the level it pulls back to, that now becomes our neckline. So the neckline is now established. You can see it starts going up again. As it starts going up again, you can see it gets rejected from a similar top, similar level. Now, if you notice, they're not exactly the same. And as I've mentioned before, they're never ever going to be the same exact points. The idea is to get it around a level. And you can see same level, rejection. So the second top is now formed. Okay, now once the second top is formed, you can see what happens. Stock goes back to the neckline and you can see holds around the neckline and then boom. As soon as it breaks the neckline, that now gives us a confirmation that this stock will most likely go down. And now if you look at this trade, was that a strong break? Yes, that was a strong break. Strong red candle, increased volume, stock takes a break, continues to move down. Very strong move. Once again, a double top, stock is going on an uptrend, hits a critical level, pulls back. The level it pulls back to becomes the neckline. Tries to break that level again, is unable to break it. Pulls back to the neckline again. If the neckline gets broken, once again, if the neckline gets broken, we then have a double top. If it does not break the neckline, we have no trade. And once it breaks the neckline, we now have a short play right here. And you can see volume spikes, strong red candle, strong breakdown. Let's look here. Right here, it's a little bit messy, but the similar concept. Double top, stock goes on an uptrend, hits one top. Now the idea is a lot of people mess up the formation. They think, oh, it needs to be perfect. You can see first top, right? And now even in between this top, we have like a smaller double top. You can see first double top, neckline, boom, right? That's one trade. That's phenomenal. Now beyond that, I'm going to look at a bigger chart and something that's much more messier. So this right here, yes, that applies as a double top as well. But if you just look at the overall chart, let's just look at the formation. First top, pull back. Where does it pull back to? It pulls back to the neckline. Neckline is now established. Boom. Second top. You can see, same level, right? Same exact level. That level gets rejected. And then as it goes down, boom, what happens? Breakdown. Goes down, hits the neckline, and breaks down from the neckline. Now the special thing about this, and I'm showing you different chart formations so you have a better understanding, is it does what? It's retesting the neckline, right? So once again, let's recap. First top, neckline. Second top, break of the neckline, retest, continuation, move. Phenomenal play. Now sometimes when you do take the trade here, which is where you're recommended to take the trade, it might go down and then try to retest. If it retests and it's a weak move up, you can always add more to your position. This could be an add-on to your trade. Look at that. Look at the wick. Tries to go up, gets rejected, boom. Sellers in control, right? And going back to this again, yes, this is a double top as well, but we're not focusing on that right now. I'm just trying to focus on a bigger time frame so you can understand the concept. And what I want you to take away from this is it doesn't have to be perfect. First top, neckline. Second top, neckline. Boom, break of the neckline, retest, continuation. Another one, double top on a daily chart, right? First top, boom, stock goes on an uptrend. You can see nice uptrend. First top. Pulls back. Where does it pull back to? The level it pulls back to, that level becomes our neckline. This is something that we establish by identifying where does a stock pull back to. It pulls back, and then you can see a lot of buying kicking in, by the wicks, right? Stock goes up, you can see around the same level again. Not the same exact point, but it's around the same level. You can see rejected, rejected. And then right from there, what happens? Boom, a strong breakdown. You can see breaks right through that, holds, continues. And look at the volume. Volume is surging, showcasing aggressive selling. So that's a strong move down. Once again, this is a double top. Now moving on from a double top, the next thing we have is something called a triple top. Now a triple top is formed when a stock makes 3 highs of equal price points. Similar to a double top, but just has one additional top. So a double top looks something like this, right? Now a triple top, what happens in the triple top is instead of the stock breaking down from the neckline after the second top, when it hits the neckline the second time right here, what happens is buyers step in and try one more time. That's why taking the trade after the neckline is very, very important. Do not take on the trade before the neckline. Take the trade once it breaks the neckline. Stock starts as an uptrend. Very important to understand. Triple top starts as an uptrend. The pattern is completed once the stock breaks the neckline. This is where the triple top has formulated. If triple top does not break this point, there is no pattern right now. It's maybe in a sideways trend. It's moving in a sideways phase. It's consolidating. All right, now let's look at an example. Right here, boom, stock is on an uptrend. As the stock is on an uptrend, what happens? First top gets established. After the first top gets established, boom, we now have a neckline. We keep progressing. You can see second top, right? Now look at the second neckline. Now if you notice something, it doesn't perfectly hit it, but it's around the same area, That's still a good retest of the neckline. And then if you look again, boom, third top. And then finally, breakdown, strong candle, high volume. That's what we want to see. Let's recap this one more time, a triple top. First top, neckline. Second top, neckline. Third top, neckline. Now if you notice something about this, it's not perfect. And it's never going to be perfect. It's never going to look like this. That's what you see in textbooks, right? That's not how these patterns are going to be formulated. These patterns are going to be a lot more messier on a stock chart. So understanding why they're going down, understanding why they're going up is very important. So understanding why this is getting rejected, right, is very, very important. So what is the psychology behind these patterns? So the psychology behind top patterns, right, is that the buyers are getting exhausted and they aren't aggressive enough to push the price higher. So you can see buyers are aggressive, sellers step in, they're more aggressive. Buyers try again, sellers are in control. Buyers try one more time and sellers take control. Once again, our trade does not kick in until it breaks that point. Keep that in mind, until it breaks the neckline. That's the psychology behind top patterns. Once again, they're not perfectly going to look like this in every single trade. You need to understand the idea behind them to formulate better and high probability trades. Next, let's go over the bottom patterns. First, we have a double bottom. A double bottom is formed when the stock makes two lows. First low, second low. The pattern looks roughly like a W. You can see, it looks kind of like a W, right? Stock starts as a downtrend. It's going as a downtrend, right? The pattern is completed once the stock breaks the neckline. This pattern also has a neckline, very important. Neckline is a very important component. The pattern is not completed until the neckline gets broken. Once the neckline gets broken, that's where your buying opportunity kicks in. So let's look at an example. So we have right here, we have a double bottom. Stock is on its way down, hits the first bottom, right? Goes up, hits the neckline. We now have the neckline established. Now what you have to keep in mind is that there's no pattern until it breaks here. The reason for that is because sometimes the stock may go down, hit the neckline, and then continue. This could just be a retracement. Remember retracements we went over in chart phases? This could just be a retracement. You do not want to get caught up in that. So the trade does not kick in until this point. So once again, stock is on its way down, hits the first bottom, retracement, neckline gets established. Boom, sellers try to push it down again. Buyers step in, and buyers are now in control, and you can see stock price starts increasing. Strong breakout, strong volume, that's what we want to see. Next, we have a triple bottom. A triple bottom is formed when the stock makes three lows of equal price points. First low, second low, third low, right? And boom, breakout of the neckline. It's similar to a double bottom, but just has one additional, this is supposed to be bottom, not top. It has one additional bottom, right? It has one additional bottom, not top. You can see one bottom, second bottom, third bottom, right? Stock starts as a downtrend, and keep in mind the pattern is completed once the stock breaks the neckline. Let's just recap this one more time. Triple bottom, first bottom, retracement. Second bottom, boom, picks back up, gets rejected, neckline, neckline. Third bottom, boom, breakout. Let's look at an example. You can see stock is on its way down, hits the first bottom. Retraces, neckline now gets established. Goes down, second bottom. Boom, retest the neckline. And then number 5, retest the same third bottom. And then number 6, strong breakout of supply zone, strong breakout of resistance level. Now just to recap once again, first bottom, retracement. If this keeps going down and breaks that point, this is now a continuation sell-off. That is not a double bottom, triple bottom, anything. That's just a continuation sell-off. This was a retracement. The stock is not going down, right? But in this situation, it goes down. Buyers step in. Sellers are in control. Buyers step in. Sellers are in control. Buyers step in. Sellers try to take control, but boom, buyers overtake them. Here's another example. You can see stock is on a downtrend. First bottom. Neckline. Second bottom. Neckline. Third bottom. Break of neckline, you can see has a little hard time, consolidation. Boom, stock makes a nice move up. Now, if you notice something about this triple bottom, it's not perfect, right? It's not a perfect triple bottom. Like I said, perfection does not exist in the market. But what does exist is knowing the idea. First bottom, second bottom, third bottom, and boom, breakout. The trade does not kick in until it breaks the neckline, because this could look something like this as well, right? So the trade does not kick in until it breaks this neckline. Make sure you take the trade after. Make sure you see strong volume. Make sure you see a strong breakout. Do not take the trade in here thinking it's going to break out, because sometimes they may just keep trading sideways. What is the psychology behind bottom patterns? Sellers are getting exhausted and they aren't aggressive enough to push the price lower. You can see sellers are in control, buyers step in. Sellers are in control, buyers step in, right? Sellers are in control, buyers step in. Sellers can't keep trying to bring the price down. There's a lot of aggressive buyers, a lot of aggressive buyers, a lot of aggressive buyers sitting here, and sellers just get very, very exhausted. And then once, or if the stock price breaks this neckline area, that is a strong breakout, right? Now let's go over some examples. Now in here, if you guys look at this example, we're looking at Shopify. You see stock shop is on a healthy uptrend. Very strong, healthy uptrend. As it's on a strong, healthy uptrend, you can see first top, neckline. Second top, coming to the neckline. Now the problem a lot of people make here is, and I've said this multiple times, is they get in before the breakdown of the neckline. The neckline has not even broken yet, and they get in. So right now the neckline has not broken. So what a lot of people automatically assume is, oh, this is going to be a double top pattern. Oh, it's going to go down. Cool, I understand where you're thinking that, how you're thinking about that, and that makes sense. But you need to understand that you have to be patient. So if you were patient and you don't see the break, you can see buyer stepped in, you wouldn't take the trade. If you weren't patient, you took the trade. Now let's walk through the full trade on what happens. See, no break on the neckline level yet. It tries breaking it, but no break. Boom, look what happened, right? This is now a consolidation period. Stock goes up, takes a break, continues to move up. A lot of people get trapped here. They're short, thinking it's going to go down, but in reality, they get trapped. Stock moves against them. So that's why you need to wait. Be patient. Be patient for the move to work in your favor. Be patient for the stock to show you something. Right here, it's not showing anything. Right now, when we look at it, it would look like, okay, yeah, obviously I wouldn't take this trade. It looks like a consolidation period. Right now, yes, it easily looks like a consolidation period. But what you have to understand is you have to look at this point. Here, it doesn't look like a consolidation period or anything. The way people look at it at this point is, oh, it's a double top. Cool, fine. But wait for the breakdown. If it does not break down from this level, do not take the trade. If you were patient, right, you would see the breakout. And then once again, as we went over in chart phases, uptrend, consolidation, takes a break, continues the uptrend, and you can take the trade on the breakout level. All right, let's go over one more example. Trading a top and bottom pattern, right? I'm going to give you guys one example right now, and obviously moving forward, there's lessons that are going to give you a lot of different examples of other patterns too, just to kind of test your abilities. But right now, I just want you to have a solid idea of forming one of these trades. Now, at this point, when you see a pattern, any pattern it may be it a double top, triple bottom, inverse head and shoulders, any pattern out there, you always start out with the watch mode. You're watching the pattern. You're watching the chart. Right now, we have no trade. We have 0 trades right now. The only thing we have is we know that this is potentially forming a double top. It has not completed the double top until it does what? It breaks this 228 mark. So us as traders, we want to see a strong break from the neckline. This is the neckline. So we are not looking to take on a trade until we see a strong move down. Until we see a strong move down here. That's where we would take the trade. So right now we are in watch mode. We are not taking a trade, but we are ready to take a trade if the stock does what we want it to do. Boom. What happens? We go into execution mode. Stock breaks down, strong move down. You can see strong volume, strong candle, breaks the neckline, strong sell-off. This is where we start executing. This is where we have a trade set up. This is where we start processing the trade. So how do we set up the trade? Now, obviously, when it's forming the double top, we're watching like a hawk, and we're very, very, very focused on waiting for it to break, right? Boom, execution mode. We have a stop at 228.9. So that's our stop loss, right? We have our entry at 227.8. And once we go over more entries and exits, I'll show you how to navigate through different time frames. Right now, we're in a 5-minute time frame. For us to kind of execute this trade, I would look at the 1 minute along with the 5-minute, and I'll break that down once we get to it. I would take the entry at 227.8, and this is a stock that I have traded, and my profit target would be at 224 exact. Why 224? Because usually I'm expecting this similar move right here, this 4-point move, to also kind of happen here, right? So this is $4. Usually on a double top or any pattern, at times you would see a similar move, and also beyond that, you can see where the stock started moving. That's where it started moving. So that would be kind of my support level, or the next level that I would watch to take profits. So looking at this trade, I enter on this breakdown. I'm looking at the 1-minute candle, right? Once I take the trade, I have my stop. So this is my potential loss on the trade. And if I'm right and the trade goes my way and I do sell at my profit target, you can see my profit target is far more than my total loss amount. Now, as the trade goes down, look what happens. Trade management mode, right? Now, once you're in the trade, if you notice something, the price didn't hit our price target, but as a trader, we need to manage our positions and not be stuck on exact points. What does that mean? Yes, I took the trade at this point and I had a profit target of 224. If you notice, it didn't hit 224 exactly. It got close to 224, and what happened? It started picking up. You as a trader need to be able to recognize those moves down. And recognizing those moves down are extremely, extremely important because you don't want to be stuck on getting out at exactly 224. You're entering at 227.8 as a short position, and then once it gets close to 224, you have to manage the trade and recognize that, okay, it looks weak. It looks like it's going to start going up, so I should take out profits or get out of my position at 224.4 instead of trying to sell exactly at my profit target.